Good morning, everybody, and welcome to the first in this IMAP webinar series on global equity investing in the context of managed accounts. This is a critical part of almost all managed account portfolios, multi-asset class managed account portfolios. And we've decided with this series to try and understand in more than just one webinar what the issues are that face decision makers for managed account portfolios. So we've approached this as a series of three to be held Monday, Wednesday, Friday of this week. And today we're lucky enough to be joined by Piers, Bolger and Nathan Lim from Morgan Stanley Wealth Management, Piers Bolger from Viridian Advisory and Infinity Asset Management. Nathan's also going to be our moderator for the rest of the series, and I'm looking forward to this. Today, we're really going to talk about some of the practical implementation issues which face licensees involved in managing portfolios. And then to Wednesday and Friday, as you'll see on the screen, two more sessions, firstly focusing on macro themes, the themes that are driving global equity markets, and then on Friday, issues around stock selection and and portfolio management for Australian-based global equity managers with managed account portfolios. If you have a question today, feel free to ask those. Nathan, Piers and I will see those at the bottom of your screen. You'll see a Q&A button. Type your question in there and we'll pick it up as we go along. The format of today's session is that Nathan will start off initially talking a little about the issues as Morgan Stanley see them. Morgan Stanley, of course, have a rather specific client base, many of whom are internationally oriented in their investment outlook. And then Piers will talk about the Viridian approach to portfolio management. So it's a pleasure for us to now commence this series of three webinars on global equities in a managed account context. And it's my pleasure to hand over to Nathan Lim from Morgan Stanley Private Wealth Management to talk about their approach to these issues. Nathan, over to you.
Thanks, Toby, and thanks for inviting us today. Hi, everybody. So my name is Nathan Lim, and I'm the head of wealth management research at Morgan Stanley here in Australia. Just up front, I'm filling in for the platform team who are infinitely a lot more knowledgeable than I am on this issue, and I'm really speaking on their behalf in terms of just trying to explain some of the challenges that our clients face. And if you would like more information, we can definitely arrange for you to get more, to get some time, or just send your questions through, and we'll try to get some feedback from our platform team. So I'm just going to be speaking to two very quick slides today. Toby, would you mind just flipping over to the first slide? These are sort of like the 5 key issues that come front of mind that we think for a typical investor who's wanting to invest overseas. They're time zones, taxes, execution, foreign exchange, and costs. So I'm going to go through each one in turn. So let's just take a look at the first one, time zones. That's what time it is in New York, London, and Hong Kong. They're clearly behind us. And while it seems obvious that the time zone is behind us, a lot of people don't actually understand that that actually creates a problem when you actually try to buy something that's listed on the ASX but trades in another country, because quite frankly, it's actually closed. The underlying market that you're trying to access is closed. And so the best example I like to use is around the use of ETFs, where a market maker basically has to build a margin into to account for the fact that there's the unknown. And so as a result of the fact that you're trading in different time zones, it means that implicitly you're going to have higher transaction costs versus executing in a live exchange, okay? Number 2, taxes. Now, just to be very clear, we're not providing tax advice here. This is not tax advice. Always seek your own tax advice for your personal circumstances. But just at a high level, following on from this time zone issue, when you go direct into other exchanges, you do face local tax considerations. Like in the US, you got to deal with the state taxes, which can be quite onerous. There's also the issue of withholding taxes. You often automatically get withholding taxes deducted from your account. You then have to go through the exercise of claiming back these taxes that were withheld against you with the ATO, assuming that you've already made the appropriate arrangements with an accountant, and an existing tax treaty exists between Australia and that other country. Fortunately, a lot of those complications can be dealt with if you look at UCITS, structured funds, as just one simple way of getting away from all that complexity. Third thing is around execution. Not everywhere is like Australia, where you can buy one share in a company. This can be particularly troublesome if you have small portfolios. So, for example, countries like Japan, they've got lot sizes of 100 units. And so if you don't, when you have these sort of minimums, it means that you generally have to have larger portfolios to get well diversification. But beyond countries who have minimum lot sizes, you also have situations like Amazon, for example. If you want to buy one share in Amazon, it will cost you $4,500 Australian dollars to actually buy one share, right? So if you've got a $10,000 account, how do you get diversified when one share in Amazon already eats up half your value? The other thing as well is watch out for brokerage costs. Just because when you go onto an SMA platform, of course, you're going to incur trading as you go in and out. And also, just as a last thing to consider about execution as well, just because a platform says that they don't have a minimum, because of the unit size, because of these odd lot sizes, you yourself should just be aware of that issue and try to make sure that you actually go to an SMA solution with a reasonably large enough a portfolio to start with. Moving now to foreign exchange. This is actually a very sticky one, and this is one that a lot of people actually don't spend enough time thinking about. The fundamental issue with foreign exchange is that they're not really transparent markets. Like, there is no concept of VWAP. Like, you don't know whether or not you actually got a good price when you actually converted your foreign exchange. Now, we're aware, for example, in some PDS statements, they include wording around a competitive foreign exchange rate, but that is actually a very undefined term. And so it's actually very difficult to get a good idea on whether or not you actually got a good price. Another thing you need to be considering, and again, this is something that's not well publicized, is that if you have a platform that cannot handle multiple currencies, it actually adds another wrinkle when you start transacting overseas shares. So I'll give you a simple example. If you sold, let's assume that you already own Amazon. If you sold your Amazon shares and in the same day bought Microsoft, what effectively happens is that the sale will generate US dollars, which then can get converted back here in Australia in Australian dollars. At the same time, the transaction for the Microsoft buy goes from the Australian dollar account and converts back into US dollars. So even though the transaction itself is all happening overseas in the US, there's actually two cuts of the transaction that go through foreign exchange. And as you can imagine, every time there's a transaction, there's cost. And that's something that a lot of people aren't aware of. And all this extra costs, it builds up over time. And then lastly, just on that last choice on the last line on costs, as I said earlier, there's that transaction cost that gets embedded by foreign exchange, but a lot of people always sort of focus on the fact that model manager fees on SMAs are a lot cheaper than you can find on a unitized structure. Now, I think that's a bit disingenuous. I think if you really want to make an apples to apples comparison against SMAs versus unitized structures, you really do need to think about costs holistically. And what I'm talking is beyond just foreign exchange, there's also settlement costs, execution costs, and custody costs. Now, from a unitized structure, all this stuff is just deducted from the NAV. So it's not really clear to the customer that they're being charged for this. Alternatively, on an SMA structure, all those charges are broken out within the statement. The point we're trying to make here is at the end of the day, the client's still paying for this, right? And so, look, in fairness, we do like the fee transparency that comes from an SMA. That definitely is a much improved situation. But it's not simply always clear cut that just because you're an SMA, it's going to be cheaper. And I think the more important lesson here is you need to start doing some math around fixed versus variable, and what is sort of that break point between when, you know what, I don't want to be charged a variable rate, I just want to be charged a fixed rate in terms of implementing my portfolios. Okay, so those are sort of like the 5 sort of big key issues that we think about in terms of that come to Morgan Stanley. But now I'm going to flip the page and just very quickly, Toby, if you flip to the next slide, just really quickly, how does this relate back to Morgan Stanley? Well, in Morgan Stanley, we've got something called Private Wealth Manager. This is our global platform. It's we internally call it PWM. In terms of time zones, we operate 24 hours a day. We've got a trading desk that's always open. What this means is that we're always striving to achieve best prices and best execution for all our clients in the local exchange, in the local time zones. When we look at taxes, earlier we spoke about UCITS structures. UCITS structures are effectively listed overseas. Our platform is able to transact and also hold foreign securities. And also flag as well that we also have direct access to 43 exchanges around the world. In terms of execution, for SMAs, we don't charge brokerage on our trading within SMAs. So that's a cost advantage that we pass through to our clients. We also have ensure that our minimum balance on our PWM platform is $250,000. And this really deals with that odd lots and creating unexecutable instructions. In terms of foreign exchange, PWM, it truly is a multi-currency platform. Going back to that Amazon, Microsoft example I gave you earlier, because they are on the same exchange, when you do that buy and the sell, there is no sort of double cutting in terms of the currency. In fact, you can even leave your proceeds from the net proceeds from that sale in US dollars to be used the next time. And just lastly on costs, our platform fee at Morgan Stanley is a flat fee. We basically charge $2,500 plus GST, and we find that our clients really do appreciate that benefit. And we also note that we're also able to offer household discounts as well. So look, those are sort of my sort of opening comments on our take on what you should be thinking about as an international investor when you're looking at SMAs.
Thanks very much, Nathan. Now, Piers, you run you run the portfolios within Viridian, and like Morgan Stanley, have a client base which is generally towards the upper end of advice businesses. What are the issues for you in managing the global equities part of client portfolios?
Thanks, Toby, and afternoon, everyone. So look, from our end, we probably focus on probably a more structural side of it as opposed to the way Nathan articulated from a Morgan Stanley point of view, because we don't run direct equities SMA portfolios akin to what we do on the Australian equity front. So from our perspective, we utilise external managers, ETFs, and the like in the way that we look to articulate our global equity views within our managed account portfolios. I think Nathan made some really good points, particularly around the ability to get positions in certain securities, whether it be Amazon and the like. And that's one of the reasons why, from our point of view, that we think that the utilisation of either an ETF solution, if it's appropriate, and/or external managers, does provide clients with the ability to get that broad-based portfolio exposure up front. So, as I said, one of the challenges, and clearly Morgan Stanley have worked through that on their platform, as I said, we look to utilise external parties. So the way that we approach it within our business and the way that we sort of think about structurally is really sort of 4 key areas. And first and foremost, why do you want to go into global equities? I think most people on today's call would be pretty familiar with the why. And, from our perspective, it's very much around the diversification, the global diversity, both in terms of markets, industry segments, as well as the investment opportunities that you can glean through global markets, as opposed to what we're seeing here with just a localized market. And again, just utilizing Amazon as a fantastic example on that basis. And we can think about Microsoft, you can think about healthcare, other pharmaceuticals, you can think broad-based industrials in the auto and aerospace. So there's a lot of areas within the market that clearly we can get access to that you can't get access to in a local sense. And that's really important in the way that we think about it from a portfolio perspective in terms of an overall construct. The second element, I think that probably the important aspect when we think about thinking about global equities is how do you want to get that exposure? So if you just think about the broad market segments, you've got large cap developed markets, you've got small cap, both emerging and developed markets, you've got regional exposure, so you might only want to particularly target an area such as maybe Asia, it may be particular regions, India, parts of Eastern Europe and the like. And then you've got the decision, which again, Nathan pointed out, what are you going to do on the currency front? So are you going to look to hedge that, some of that exposure, all of that exposure across certain market segments, or are you going to have an unhedged component within that portfolio? Now, from our perspective, we think that there is clearly some advantage having some, foreign exchange exposure into your portfolio. Again, it adds to the diversity, and particularly if you've got $A exposure through your Australian equities or through your cash component or through your local bond component, you're going to, as I said, pick up some of that additional $A. So having foreign currency exposure within your portfolio, we believe is particularly important and is advantageous from an overall risk return perspective. But it's really very much built around how do you want to get those exposures? And as I said, you've got multiple market elements that you can glean exposure to within a portfolio framework. So again, from our perspective, when we're looking to build out our portfolios, we definitely want all of those component parts. So we would be generally looking at certain parts of the developed market. We tend to do that in a more holistic sense, as opposed to building it from a region by region basis. We certainly want to get small cap exposure. We think there's a lot of leverage in portfolio returns through time by utilising and having some exposure to small caps. Now, clearly, at the moment, we're seeing obviously that part of the market having a difficult ride, but the operational leverage that we're seeing through recovery phase, we think is going to be quite advantageous to small to medium cap companies, and we're seeing that domestically as well as I said, what we've seen anecdotally on the global sense as well. And then you've got emerging markets. So again, emerging markets can be played either through particular regions and or through a broad-based basket in terms of a single strategy. So again, we tend to mix and match that depending upon our view on individual markets and where we sort of see valuations at a headline level. But I think that again, there's some ways that you can look to play that. And then the final element is through how do you want to manage your currency exposure. So we don't do an active overlay across our portfolios that relates to currency. So if we were wanting to add additional $A exposure into the portfolio, we'd be looking for a discrete hedge solution to cover for the particular market environment that we're looking to hedge into. So that side of it, we think, is particularly important. That structural element as to how do you want to get that exposure, the types of exposure that you want to get, and then how do you then clearly manage that on an ongoing basis, because different market segments are going to create different risks and opportunities at particular points in time. So it does mean that you do need to be on top of that and continually look to review those positions accordingly. The third element is, how do you want to get those exposures? So I spoke about the utilisation of, an ETF solution for parts of the market. You might look to go for active management. You might look to go to a really bespoke sector, such as buying say a NASDAQ ETF, if that was what you were looking for in terms of getting exposure to either tech or healthcare and the like. So again, that's dependent upon, individual market views where we see the risks and opportunities, but we certainly are very open in the way that we think about getting our exposures across our global equity managed account portfolio. I probably would say the way that we think about it, by and large, we do like, we're utilising an external manager to provide a sort of a broad basket market exposure. We generally would go to a more concentrated type portfolio positioning. So it might be somewhere between 25 to 45 stocks across the manager. We like that because when we ultimately do portfolio configuration and the blending across those portfolios, it just enables us to be able to, as I said, get a more tailored outcome. And certainly we would then know our discrete positions more easily, and you're not getting as much filler across the portfolio. But it isn't to say that we don't have the odd manager here that certainly might be holding portfolios north of 60 stocks and above. And the final element from our end is all about what type of style that you want to build into the portfolio. So if you've got that structural thematic in regards to the types of sector, regional exposure that you're wanting in the portfolio. What type of style are you looking for? So, are you looking for more growth? Are you looking for more value? And again, that ultimately will drive the types of decisions that you're making and where you're seeing valuations, particularly if you're looking at individual industry segments such as tech, healthcare, finances, or the like. Depending upon your assessment of market value, as well as the opportunities, that will probably also dictate how you're positioning and how you're constructing your portfolio. But again, we think that's a really important element that you need to be considering as you look to create the portfolio construct, because again, markets are going to be dynamic, valuations are going to change, and the opportunity is going to change. So you need to be thinking about how you want to articulate that in that style framework. And so they're really sort of the four key areas. Obviously, within each of those areas, there are certain subcomponents, but that's the way that we think about it, Toby, in the construct of our portfolio.
Thanks very much, Piers. Thank you. And I should have mentioned at the start that Nathan and his team won the licensee award in the IMAP Managed Account Awards this year. And Piers was the previous winner. So we're in the presence today of two highly experienced portfolio managers with a focus on managed account portfolios for retail clients. So Nathan, coming back to you, Morgan Stanley would have a really quite a specific type of client. How many of them are actively engaged with this part of their portfolio, have a particular view on what their portfolio should be holding?
If you're referring to international, I think that's probably one of the key drivers on why these clients of ours came to Morgan Stanley in the first instance. I think they are international by default. There's an expectation that when you have a firm that operates globally, that you're being shown global solutions. So I would suggest to you that is probably one of the key reasons, and it's that capability that we're able to bring is what we feel is a key competitive advantage. Does that answer your question, Toby?
Yeah, and how many of them are, Morgan Stanley obviously is primarily a broker, it has its background in broking. How many of your clients are actively engaged in stock trading themselves?
That's actually an interesting legacy sort of view of the firm. One of the things that we've been working very diligently on with the current management team under Ian Chambers is really transitioning the business away from its stockbroking roots and just recognizing what the Morgan Stanley business has achieved in the US to become more of a wealth manager. So we're very much evolving towards looking at our clients from a holistic perspective. Like stockbroking and trading is still a very important part of our business, but it's not the only pillar. It would be the way I describe it. In terms of, to answer your question directly, how many of our clients are actually trading stocks? I'd say that there's a good mix. There's some that, yes, they want to do it themselves and DIY, and they would use our global research and our global execution services. At the same time, that we've also got a lot of clients that recognize that they need to have that diversifier that Piers was referring to, but they would rather use best-in-class assistance in finding either a low-cost ETF listed overseas to get the best execution and the best prices, or to find a high-quality active manager. And so, again, similar to what Piers is doing at Morgan Stanley, we try to connect those sort of clients with who we think are best in class. And of course, you've got you've got DIY, and then you've got implemented, and then there's also advised. So we also will work with clients to say, well, here's some selections. Why don't you pick something, right? So it's advised, implemented, or DIY.
Piers, Viridian had its foundation in the private banking side of Westpac, as it happens. So how important is the sort of DIY part of their portfolios for your clients, and how do you accommodate that, thinking particularly about international securities?
Yeah, it's a good point. We certainly have a number of clients that do want to articulate their global equity views holding direct securities. Those clients, again, just to Nathan's point around Amazon, we certainly see that those clients have got, significant amount of investable assets to enable us to be able to construct an appropriate portfolio for them. So I think that's particularly important. Certainly our house view around that if you're going to hold call it a 20 stock portfolio in Aussie equities, you want to mirror a 15 to 20 stock portfolio in global equities. It does require you to have some reasonable capital in order to be able to achieve that. Elsewhere around that, if clients are still wanting to do that and they want to hold particular securities for whatever reason, and then you're trying to construct a portfolio to enable it to have, the look and feel of a holistic structure, then it might require, some balancing items alongside that, which would be either an ETF solution, maybe a sector or regional based tilt across those portfolios, or a broad based market exposure. So again, there's no one size fits all as it relates to that, other than we would say that, if you are going to go down the direct route, you do need that level of capital to really start to have an exposure that looks like an appropriate portfolio, rather than owning 2 or 3 Amazon shares and a Microsoft share here and there, or whatever it might be. So in that context, we certainly have those conversations with clients to make it work. But by and large, I would say the rump is certainly more around utilisation of the external managers and/or specialised solutions that we've got. But we certainly do have clients that fit into that camp, and it's appropriate to be able to cater for them accordingly. Again, where we do have those clients that are utilising direct equities, I think one of the things, again, that Nathan made a really good point on is, how do you then manage that FX exposure if you are interested in trying to manage that, or they're just happy to get the execution at whatever the spot rate is. But again, it's just something that clients need to be made aware of in terms of sort of their journey as it relates to investing directly offshore.
Yeah, I think just following up on Piers, I think that extra FX consideration is something clients need to be thinking about. I would agree with Piers absolutely that FX is a great diversifier. So you never want to be in a position where you're completely hedged or unhedged. So you just got to be conscious of that. We also take the view that it's much easier and probably cleaner to implement through a different asset class of that security. So a lot of funds and ETFs these days have offered both hedged and unhedged. And I think that is a view that you need to include in your investment journey, to say, you know what, I want this part of my portion of my portfolio to be hedged or not hedged, and that makes part of the investment decision.
So do you give specific advice on hedging, Nathan, as part of the service, or?
Well, we provide model portfolios. We make those details available, and we basically delineate how much of our portfolio is hedged or unhedged, and either then provide that sort of on a sort of advisory basis, or basically implement it for the clients through an asset.
And so it is making the hedging call part of the portfolio management process.
Absolutely. Absolutely. Everybody knows that the US dollar is a great defensive position, because what happens when the markets sell off? Australia goes down, but then your overseas holdings benefit generally from a strengthening US dollar. So you get this natural hedge in your overseas shares that you may not necessarily want to deactivate by hedging it. Right now, of course, you have to then have a view on the Aussie dollar. Our firm's view is that the Aussie dollar probably faces strong resistance by 74 cents. We're sitting around 71. So a lot of the move has already happened. It gets a bit trickier here. Do you keep putting on more hedges? So you need to be thinking about all these things within your portfolio construction.
And I think that's a really important point, because we certainly don't subscribe, and I think Morgan Stanley would be in the same boat, that your A dollar ultimately just evens itself out through time. Now, you might be able to point it over particular periods where that is the case, but certainly our view is that you need to have a view, and you need to be able to articulate that view if you can in your portfolios, as opposed to saying, well, I'm just going to let it ride and have the market impact on my performance, because we can clearly point to significant periods over the last couple of years where just letting it ride, you might say, well, the stock selection's been great, my asset allocation's been great, but my currency management has been appalling, and therefore my return profile hasn't worked out as much as I would like. So it really does need to focus as much as it relates to portfolio positioning, but also in terms of how you're managing and how you're thinking about the risk characteristics, because again, both hedged and unhedged equities will give you a different risk profile as well in the context of your portfolio. So just a few things that, I think are really important, as Nathan's articulated, in the way that you then think about putting a portfolio together. It's just not, shouldn't be viewed just singularly on the basis of either security and or utilisation of external managers as part of that portfolio build.
Yeah, if there's one thing also I can jump on that as well, I think it's also very important that when you start using external managers, or even when you're starting to put together a portfolio, that look through is really important. I think some clients inevitably, or not clients, but let's just say, I think investors in generally sort of gravitate towards performance. And unfortunately, what happens is that you might end up overloading your portfolio with the same factor. And so I think it's very important that from even at a local level, but also international level, when you start going overseas, is really understanding how exactly are these managers getting their returns, right? It's not like in Australia where you can point to CSL at 8%, the banks at 20, resources at 20, the three big weights are sort of in your head. Overseas, it's a lot more granular, and you really need to understand. And I think right now, for example, growth is a huge factor. Everybody's jumping on growth funds. But when you really dig deeper into it, it's basically the managers that got their FANG calls right. And so what happens if you add in 3 growth managers, all of a sudden you realize that on a look-through basis, you're owning the same stocks across all your funds. That's not really a good idea from a diversification perspective, because then all you're doing is that you're defeating your diversification through manager selection by overloading on the underlying stocks.
I'd like to pick up on that point about the greater granularity. In your submission to the Managed Account Awards, Nathan, you talked a little about the issues of using overseas listed ETFs and UCITS, and it would be great if you talk a little about UCITS and what they are specifically. But to what extent does the ability to take advantage of much more granular ETFs or much more granular vehicles offshore play into portfolios for Australian investors? Yeah.
Well, the simple number is in Australia, we've got about a healthy number of around 100, give or take, ETFs. Globally, we've got something like 3,000. So just in the sheer fact that there's just numerically more ETFs overseas, it means that you are able to express your views on a much more granular basis, and that's something that we do within the portfolios. But even just putting that aside, many of these ETFs, the liquidity on these things dwarfs the amount of liquidity that we see on the ASX. And what that ends up translating to is that the total cost to the client is much lower, because you get much tighter bid-ask spreads. You get a lot more underlying liquidity. You got a much more competitive market. So the market makers themselves, their margins come in. So you find that there is an efficiency pickup if you're able to pick up some of these ETFs overseas.
Piers, for your clients, how significant do you think it is or will turn out to be to have access to a deeper pool of ETFs and managed listed vehicles?
Oh, I think it's critical. I mean, we take the view the more strings in your bow, the more opportunities you've got to make decisions that can benefit the client outcome. And I think that clearly we can see that the growth opportunity in this part of the market has allowed for that over time, particularly if you look at sort of the development of the ETF space. Again, when you're looking at sort of the global market in this space, as Nathan pointed out, quite significant. But if you look back even 3 years ago, we had limited exposure to certain ETFs, and we're now seeing a lot more, particularly in, say, infrastructure and the like, and just seeing a greater array of underlying, and then you've got sub-underlying around that. So I think that that's really important for investors, and it does mean that you can really target particular portfolio outcomes that you might be looking for. And again, I just want to touch on the point that Nathan made, that really that look through is particularly important, because you can certainly see where managers may have had exposure to particular sectors and or regions in terms of the delivery of generation of their performance. So you need to be very mindful of that. from a portfolio standpoint, because ultimately you can lead to certain factor positions that you unintended biases that you just simply don't want. When the portfolio turns, you don't get the outcomes that you're looking for. So you can clearly get advantages by having growth in terms of the opportunity set, but you need to be very focused on how you want to articulate that view, and what the impact of having multiple views in a portfolio, what that will ultimately lead to. So I think that's just one of the challenges from a portfolio management point of view that people need to or should be aware of in the way that they then look to deliver the outcomes.
Now, there are a couple of questions that have come through, and I'll pick up on a couple of those. Tanzim, I'm not sure that I completely follow your question about Remisia, so perhaps if you might express that again. But there's a question here on major platforms have been slow in offering the capability of international SMAs on their investment menus, likes of a platform I won't name, promising but not delivering over the past few years. Demand seems to be there, but why the delays? Now, I know that, for example, between the two of you, Nathan, you've got private PWM, but also significant user of Praemium, which has well-developed international capability. Piers use Panorama, Hub, and I think another. So let's talk about SMAs on platforms and why you think they haven't yet taken off to the extent they might have.
Well, I can certainly, for one of those ones that you pointed out, Toby, you can't do direct on there, and I think that there is a clear functional element associated with the platforms at the moment, both in terms of the minimum dollars required. So a lot of them can't do fractional ownership, for example. So again, that Amazon point that Nathan made, the inability to do that means that you need probably well upwards of maybe $250,000 if you're going into direct sense to be able to get some level of exposure that you would think would be appropriate. So and we think it's well north of that, to be honest. So again, I think that the construct, particularly around fractional ownership, needs to be addressed at a platform level in order for domestic investors here to be able to get advantage of that. There's the trading associated with it, that if you do go into it and you don't have sufficient, you're basically just sitting in a cash account on the platform. So again, there's some operational issues that need to be addressed. So, I put it down to probably the required capital that an individual investor would need to invest to make it work. And then secondly, obviously, where the platforms are at in terms of their life cycle around having the right tech to be able to support the outcome around that. So that's, clearly a challenge at the moment for the industry as I see it. Not necessarily all parts, all platforms aren't created equal, but, certainly a number of them out there at the moment. So I think it's a fair point. I think it's one of the reasons why we haven't sort of seen the uptake akin to what we've seen in, domestic equities as an example.
If I can take a slightly more conciliatory sort of way of answering that question, I'd say that in the first instance, so look, I've been a fund manager for much of my career, and before I came to Morgan Stanley, I ran a global equity fund for a certain ethical organization. It was about a $250 million fund. It's hard, picking direct stocks is not like in Australia. It is, you've got much deeper choices in sectors. You've got a lot more complexity around that regulatory framework, around the environmental framework. It is a big world out there. And so I would also put it down to be careful what you wish for. Just because you can suddenly start buying Tesla shares, or you can get your hands on Bitcoin and all these really great sort of headline grabbing sort of returns, there's a lot of risk out there. And I think from an Australian investor's perspective, what we always try to encourage all our clients to do is go in with an open mind, go in with as much information as you can, but also get advice. And so our preferred route is that, one, make sure you're armed with the best research you can get your hands on, and two, if you don't have that, make sure you're armed with the best fund managers this country has and go with them and follow what they're doing. So I would suggest to you that there are enough capabilities, there's enough offering out there today that you can create very credible very effective portfolios that already have what's in the market.
And I think that's a really good point. I mean, to the extent that saying about the individual ownership, but if you do just think about the we're talking ASX, let's call it 300. MSCI's got over 7,500. So where do you start, and how do you actually distill the market into the investment opportunity? So I think there is definitely so many challenges Nathan points out, which is why you do gravitate to experts that have got the resources, both domestic and global, to be able to bring that research and be able to articulate that into a single portfolio view.
So there's a question here about balancing out sector exposure between Australia and international equities. I mean, the Australian market clearly dominated by banks and miners and a couple of kind of single stocks of significant sizes, such as CSL. So in your own portfolio construction, to what extent do you let these the domestic sector considerations play into the way in which you manage global equities?
You want me to take that one first?
Yeah, you go, mate.
So look, at the end of the day, the first thing you got to ask yourself though is what's your benchmark, right? So if you're actually benchmarked to the ASX 300, then those sector exposures aren't really that important because you're supposed to own that, right? If you make changes to those underlying sector exposures, then you're basically going off benchmark. So I think you got to be a little careful about that discussion when you start looking at it from a portfolio perspective, because at the end of the day, I need to be able to say to a client, the market is up, you're up. The market is down, you're down. That's the expectation I feel that most clients would expect. What they don't want to see is the market is up and you're down, right? They don't want to see, like, it's kind of, we always sort of criticize active fund managers for benchmark hugging. It's like, oh, what are you doing? But that's important, right? Because at the end of the day, the market is a very powerful force across all asset classes. And so making those sector calls can be quite challenging. And so I always take it back to, well, what are you being measured against, right? So in that instance, to answer the question directly, are you overloading on banks and resources if you were to buy it again overseas? Well, yes, you would, because if you've already got your ASX 300 or ASX 200 exposure, then adding more would mean that you're making an active bet. Do you necessarily want to be doing that right now? Well, a lot of people are sort of falling to the view that you need to be looking at value in your portfolio. And one of the easiest ways to add value are the financials, right? So maybe this is a good time to be adding more. So I guess to answer the question directly, again, sorry, it's like you need to have a fundamental view that causes you to move off benchmark if you want to start playing sectors. And again, that's driven solely by how much IP you have and how much research you have and the conviction on that call.
And is that a view you'd share, Piers, that, or do you choose international equity managers or international equity vehicles, and then leave the managers or the vehicle to get on with the job, regardless of, say, domestic sector exposure?
Well, we certainly, if we're choosing an external global equity manager, clearly we won't be conversing with them in terms of their stock selection on that portfolio. But to the point, we definitely would be looking at that manager as it relates to what else we've got in the portfolio. So if we're holding Aussie equities, and again, to Nathan's point, and for example, we're massively underweight financials in Aussie equities, as we all know, it's circa 25%. So again, that benchmark rel becomes an important aspect because financials are nowhere near that. They're half of that again in a global portfolio framework. And so it's all about understanding what that looks like. But we wouldn't want to be doubling up if we had a view that was contrary to that position. Understanding though that not all financials across global markets are going to be in the same boat as what we're seeing here, for example. So it is really important to, again, have that look through. And it's one of the reasons why, certainly from our end, it's a lot easier to look through a portfolio of, call it, 30 to 45 stocks as opposed to it is to look through a portfolio of 160 stocks that clearly you can get if you're looking at managers. And then if you're looking at an ETF solution, you've got to then think about, well, what are the key drivers of that ETF solution if it is a market cap-based ETF, and how is that then going to be articulated across the rest of your portfolio. So we certainly do look at it. Again, it's all about understanding what is the end portfolio looking like. But you know, if we have a double up on materials, you know, you might have Barley and then you might have BHP in your portfolio. Again, it's just about, well, where do we want to massage that overall exposure, let's say to iron ore as an example in that instance. So, but you know, that's just part of the work that you need to do in terms of portfolio construction.
Look, a couple more questions. One of our questioners has said 100,000 would get you reasonably covered and aligned in Direct International. Do either of you have a view that is a view you'd take or not?
I think that's low, personally.
Yeah, I'd point to the fact that our minimum on the SMA is 250.
Yeah. Okay. Great. Look, there's a question here specifically for you, Nathan. Does Morgan? We mentioned Amazon. I mean, I think back to a portfolio we ran, which had Japan East Railways in it at that time, $90,000 per share. So we had one, I think. Does Morgan Stanley actually offer fractional share purchases?
Toby, I actually don't know the answer to that question. I'm going to have to revert to my platform specialist guys and get back to you on that one. Sorry.
Yeah. Invest in a unit trust. That's effectively fractional ownership. Is a pooled vehicle. There's a question here. Is the lack of research coverage by local firms over international equity SMAs a limiting factor? So, yeah. So
research houses, or research, do you think?
Sorry,
yeah, sorry. I'm not sure if that was referring to sort of research that Morgan Stanley or UBS or Citi do, or whether
from the questioner, I'd say it's a general question. Yeah.
Yeah, look, I think that there certainly is research coverage. I think that we probably don't see the same level of global equity SMAs in the local market. I mean, we've certainly got, you know, probably 3 or 4 that I can think off the top of my head, but it isn't to the same extent as what you're seeing in the domestic side of things. So, you know, Zurich have got one, FT have got one. I think there's a couple of others on that basis. So, but again, I think it's probably fair to say that the research hasn't gone down that same road as what you've seen as it relates to unit trust.
Mm-hmm. Okay. All right. Look, let's. We've covered currency. We've covered hedging. Well, actually, let's just talk a little about hedging. So, to the extent that you take a view on the extent to which a portfolio should be hedged, what are the vehicles that you would expect your clients to be using? What would you be recommending to clients for hedging if there isn't, for example, a specific hedged option of an investment that you want to take?
Are you asking, would we be taking a hedge position now, or are you referring to?
No, I'm asking if you decided you did want to hedge overseas exposure. Would you be only investing through vehicles that offer a hedging option, or would you be looking for example, US dollar ETFs bought locally? Or
yeah, look, it's going to be very client dependent. I think as sort of a general answer, the easiest and most elegant is always to go with the hedged asset class version and allow the hedging to be done at the unit level. That's just a lot more cost efficient and a lot cleaner. Alternatively, we can put you in touch with our structured products desk, our derivatives desks, and we could build you a hedge if that's what you needed. So we've got both answers. Would be the way I'd answer it.
We take a similar approach as well. Sorry, Toby. We take a similar approach on that basis. I think that where we would start to think about is, you know, as again, is it in large caps, so we want that exposure? Is it in small caps? We rarely would have a hedged exposure through EM, just given that by and large, a lot of, or certainly the more significant EM markets, you know, generally have a correlation with the A dollar anyway. So you're not necessarily getting the benefits associated with that, just given because a lot of them are either growth or commodity based on that front. So again, it just depends on how you want to articulate the particular exposures that build your overall global equity configuration. Again, to Nathan's point, we don't take the view that you just need a single brush and that's the way you're going to get that exposure on a continuum. You know, you do need a core framework, and by and large, we would articulate most of that through large cap, because certainly when you're looking through the costs associated with hedging, you generally, obviously, it's the more liquid, deeper markets, it's a lot less costly to do that if you're looking at, you know, regional or EM markets as an example, small caps as well, depending on the volume that individual companies can get through. So, but it doesn't mean that you exclude those from the way that you think about that that exposure.
All right. Look, thanks very much, guys, to both of you for your insights into this important part of the portfolio. Let me just share now, to wrap up, a reminder of the next two sessions which we have coming up on Wednesday. And Nathan has kindly agreed to moderate both of these sessions. So Wednesday, Francine Mew from Franklin Templeton, a portfolio manager there, and Monica Kotecha from InSync Funds Management, probably one of the most experienced global equity SM or managed account managers in Australia. Certainly one of the somebody with over a 10-year track record of managed accounts in international equities. We'll be talking about the themes that seem to them to be dominant in their way of thinking about global equity markets at this time. And then on Friday, we'll be drilling down to the sort of approach which both Piers and Nathan talked about, which is the ability to run concentrated portfolios from Australia of international stocks, and the way and the sort of particular insights that are required to make a success of that. We'll be joined by Mark Arnold of Hyperion Asset Management, Tom King from Nanook, as many of you will know, an ESG-oriented portfolio manager, and Lachlan Hughes from Swell Asset Management, a boutique Melbourne-based manager. So thank you very much for your time today. The questions, to the extent that we haven't been able to address them, we'll send a note back to the questioners about those. So thanks for your time. Thanks for joining us. And we'll look forward to you joining us again on Wednesday and then on Friday. Look forward to that. Thanks.
Thanks, Toby.
Thanks, Toby. See you, Piers.